please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, India's banking landscape could undergo a massive overhaul. CNBC TV18 learns that the government is considering a proposal to allow 100% FDI in private banks. Lata Venkatesh joins us with what could this mega move mean for the Indian banking sector. Hi Lata, good morning.
Good morning, Nigel. Well, it's very obvious that there has been a huge amount of hunger for stocks like HDFC Bank, where the foreign limit of FDI plus FII has already reached 74. And hence, any further purchase will have to be only 25% foreigners. I mean, HDFC Bank, if it's going to raise capital, can only tap to the extent of 24% from FII's all additional capital. If this rule breaks out, if this rule turns out to be true, then you're going to have, a stampede for HDFC Bank kind of shares. And that will be true of others as well, because Uday Kotak will eventually have to bring his stake down from 40. People will start warehousing shares right from today. And as Morgan Stanley's note pointed out, MSCI indexes will also change their weighting of stocks like HDFC Bank and Kotak Bank. So people will have no choice but to go and buy. And I don't think they even need that kind of a stick to make them buy. There is so much hunger for the well-run Indian private sector banks. And perhaps that explains why there was already a rally in banks like ICICI and Axis and HDFC Bank. Over the past 2 days, we've seen the Nifty Bank break out of its resistance and go to new highs. So definitely there's going to be positive. But let me add a very big caveat. This is a proposal. And this is what our sources are telling us. Whether the proposal will fructify, what will be the RBI's view. Yesterday, we had two RBI deputy governors, former deputy governors, telling us tread with caution. RBI has not been a big votary of allowing too much of foreign capital without reconsidering. This is only capital, it's not ownership. It's not as if an HSBC can come and buy a Karnataka bank or an Axis Bank. So the rule that one entity can hold only 5% in a bank will continue. So there will be all these controls, but for the FII and the FDI who are holding the shares, it is going to be, absolutely a Diwali. I still believe that you should take it as a proposal and not a done deal.
Okay, so word of caution coming in there that it is still a proposal and tread with caution, but that is certainly going to occupy a lot of mind space for the investors today. But let's get on to the earnings now. Bharti Infratel reported its Q3 earnings yesterday. The revenue came in flat while the profit after tax was down about 8%. Ronit joins us with all the highlights. Ronit, good morning. Tell us, how did the numbers look?
Good morning, Anisha. As expected, no surprises coming in from Bharti Infratel. The revenue came in flat around 3,600 crores. The EBITDA slight downtick come in there. And the margins also, we were expecting a 600 basis point hit, and that came around 44.1. But the big surprise was the PAT. That came down around 8% at 585 crores versus our estimates around 695 crores. And the other thing to watch will be the tenancy deletion. We were expecting a tenancy deletion of close to around 712, but it came at 6,600. Tenancy ratio refers to the average number of operators that have to put an antenna on the towers of Bharti Infratel. So, on the back of this, you can expect the stock to be in light green today. Active.
Okay, all right, Ronit. Bharti Airtel will be reporting its Q3 numbers as well. What do we expect there?
Yeah, we're expecting a weak quarter coming in for Bharti Airtel. Last quarter, largely because of the African business, the stock outperformed the other telecom stocks. And I'll start with what we're expecting. We're expecting a revenue downtick of around 4% on the consolidated business to around 20,800 crores. As well as we're expecting the EBITDA downtick around 5%, largely due to the India wireless business. Now, moving on to the margins, we're expecting a slight uptick in the margins because of the African business. And we're expecting the PAT to be down around 21%. Now, moving on to the African business, which was a big surprise in the last quarter, we're expecting a revenue downtick largely because of added competition, but we are expecting the margins to remain stable. This is largely Kotak estimate, wherein they're expecting the margins to come in around 33% versus 32.3% last quarter. Finally, moving on to the average revenue per user, we are expecting the average revenue per user to fall to around 127 from 154 last quarter. So, if you see even the table from the highs of 196 in Q1, it's come all the way down to 154 in the last quarter. So, on the back of all this, we'll have to watch for the ARPU as well.
Okay, all right, Ronit, we'll keep an eye out on Bharti Airtel today, but we'll also be looking out for the Adani ports because they'll be reporting the Q3 numbers. Anisha, what do we expect there?
Well, yes, Nigel, this time around we're expecting a decent quarter to come by. Remember, last quarter was very weak, given there were a couple of shutdowns as well. It was only the SEZ income that really supported the numbers last time. Now, the management commentary regarding Q3 was strong, and that is what we are expecting as well when the numbers come out at 230, 245 today. Now, in terms of the numbers, I'm looking at a revenue growth of 8.5% and EBITDA growth of 17%, led by the margin expansion that should come close to 66% versus 61% that they did last year. As a result, the profit is expected to go up by around 1%. Now, the profit growth will be a bit limited because remember, there is a tax rate increase when it comes to the company, and that is what should limit your profit growth. But other than that, in terms of the volumes, the street is expecting a volume growth of anywhere between 12 to 15%. Now, 20% growth is what they're expecting when it comes to container volumes, as well as remember all the new ports like Kattupalli, CT4, Mundra, Hazira, all should come into play and add to the volume growth this quarter. The bulk volumes are also expected to go up because remember last quarter that was a bit weak given we had seen a couple of shutdowns happening at the HMEL refinery as well as Dhamra port as well. Other than that, in terms of key monitorables, now last time the company was a bit ambiguous when it comes to the guidance. They did not reiterate their guidance of 12 to 15% volume growth. So let's see whether they come out with the guidance this time around or not. Other than that, impact of GST on volumes is what they had alluded to in Q2. Well, let's see whether it impacted numbers in Q3 or not. And lastly, balance sheet issues remain important for Adani Ports. We have seen the stock reaction coming on that. So anything coming on that front will also be important. But Ultranex Cement also comes out with its numbers today. Nigel, what are you expecting from that? Is it a long day for you coming in the later half?
Well, it's going to be a heavy lunch actually because it's going to come at lunchtime. Okay. 1 p.m. to 2 p.m. That's when I'm looking out for Ultranex Cement's numbers. And in fact, this chart is telling you the stock has rallied more than 35% in the last 1 year. It's trading close to its all-time high. So just keep that in mind. The stock's never been cheap, remember. It's, trades at around $210 per ton in terms of an EV per ton, 30 times its forward earnings, 17, 18 times EV per EBITDA, but it's been a class performer. Let's get back to the numbers then. On a year-on-year basis, the numbers are not entirely comparable. Why? Because in the base year, JPA, that's JP Associates cement plant assets, were not present in the base year. But in terms of the numbers, on a year-on-year basis, well, we're going to be looking at a 25 to around 27% growth in terms of the top line. What that's going to be aided by? Volumes, obviously. JPA's assets will come into the volumes. So that's going to help the total sales volumes should come in higher by around 20% approximately at around 14.1 million tons. That's the number we're working with. Remember, in terms of domestic sales, we need to keep in mind that in fact in the base year it was at around 11 million tons. So look out for a growth of around 20%, telling you we're expecting realizations to go up by around 5 to around 7%. Why does this happen? Primarily because of JPA's assets coming into their books and also the standalone number, that is ex-JPA, Ultratech's volume should grow by roughly around 6 to around 7%. The assumption that the street is working with is that Jayaprakash Associates cement assets that in the first quarter of this year had a capacity utilization of roughly around 15%. That's likely to move to around 40-42%. Remember, by quarter 4, the management has guided that it could go to nearly around 60% or thereabouts. In terms of operating profit, well, we're working with a growth of around 19%. Margin should see a bit of a compression. Why? Because in fact, JP's profitability is lower than what Ultratech's profitability is, and also high energy costs because there was a part petcoke ban. That's what's going to affect them. Finally, profit number should come in lower by around 24%. Why is that? Finance costs will spike up because they'll be taking some of that debt from JPA's assets into their books. So that explains why, in fact, the profit number should come in lower by around 20-24%.
While FMCG major Hindustan Unilever reported a stellar set of Q3 earnings, the volume growth came in at 11%, crossing double digits for the first time in 5-6 years. Mangalam Malu is here with all the highlights. Mangalam, good morning. The numbers look really splendid, but would the valuations limit the stock move today?
Not sure about the valuations limiting the stock move today, Anisha. In the last 1 year, everyone has been talking about valuations being high, but the stock has moved from strength to strength. But just take a look at the numbers. The good part is that the volume growth, which came in at 11%, has come in double digits for the first time in the last 23 quarters. So that is a positive. And any which way you cut it, you can say, they had a favorable base or not. But the quality of earnings, revenue growth of 10.7% ahead of the estimates. And with that, We had the EBITDA and margins also ahead of the estimates. Net profit growth of 27%. You can talk about valuations, but if the company is posting a 27% EPS growth, you know, people will give it that sort of multiples. Margins, they beat expectations, led by gross margins, higher gross margins, and they did not hold back upon fire. The ad expense, that one was higher by 25%. Despite that, the company went ahead and improved their margins. More importantly, we've been hearing the management for many quarters, and for the first time, they're sounding fairly bullish. They said that the domestic comparable revenue, that one actually grew by 17%. Add to that, they expect the gradual recovery in demand to sustain. This compares with their earlier comments of expect gradual recovery in demand. The only fly in the ointment could perhaps be the raw material prices. Crude is at 70 now. That is something that the management did speak about, but then again, they also categorically said they have a few lines of defense to mitigate that before it hits their operational performance. Brokerages, well, if you're a bull, brokerages will say this is a strong performance and they maintain their ratings, outperform with a higher target price. Credit Suisse, for instance, we have Morgan Stanley too. Morgan Stanley has been a bear on HUL for the longest time, but they too have increased their target from 1,000 to 1,120. And the bulls, we have Macquarie as well as Deutsche Bank. Both of them have targets of 1,600 and 1,700. Yes, valuations are a bit of a concern, but again, the company is delivering on the numbers.
Absolutely, Mangalam. Thanks so much for that. Well, all along we were waiting whether or not there was some rumor in terms of an open offer. That's not come about. But the numbers are doing well, and in fact, they are reporting good numbers, and the stock has given you returns of what, 65–70%, as Mangalam told us.
Well, let's head straight to the commodities corner, where Manisha Gupta is standing by to get us all the updates from the world of commodities. Manisha, good morning. Take it away.
Thank you so much for that, Anisha. Well, we have seen the crude oil prices continue to gain firm, and this is ahead of the U.S. weekly inventory data today, where the markets are anticipating a 9th straight week of draw in U.S. inventories, and that is keeping the prices higher. But on the other side, you also have seen quite a stretch in the gains. The speculative activity has been quite bullish. There is some profit taking coming in on the higher side. Markets also are watching the currency play here, where you have seen the US dollar come off its 3-year lows, and that's given some profit taking in many of these commodities. Having said that, there is just so much to follow when it comes to crude. You have the U.S. shale output, the U.S. exports to take cognizance of. You also are looking at the OPEC compliance, which has started to falter as prices are nearly 50% up from where they were 6 months ago. So a lot to watch out for. Having said that, we still are on the higher side of the range for the crude oil prices today as well. It is a metal space which has gone in for a bit of profit taking. The New York session yesterday saw a decline in most of the metals, and it's trading quite flat in the Asian markets right now. The metal that has been holding firm really has been gold. 4-month highs on that. We still are around those 1335, 1340 kind of levels. Gold prices are up 8% in last 1 month now. And there is the U.S. retail sales and the China data that the markets would take further direction from.
Okay, all right, Manisha, thanks so much for joining in, giving us those details. But let's shift focus to the cues coming in from the derivatives market. Remember the FIs, and in terms of their long-short positions, it's even Stevens at 50-50. Mangalam joins in. He's going to run us through all those details. Mangalam.
Even Steven, Nigel, 50-50. It's a perfectly poised market. If you take a look at the FNO Qs as well, we have seen a lot of purchase in the cash markets. The FIs go ahead and hedge themselves in index futures, sell in index futures around 667 crores. So that is something which is a positive, primarily because of the cash market purchase. Another thing that really stands out is if you take a look at the Nifty futures premium, we are seeing some supply at higher levels, but then again, that is primarily on account of the hedging that we are seeing. The most important thing is the put-call ratio. That one has also gone above that 1.76 mark, so we'll watch out for that. But then today, it's all about the Nifty Bank. The Nifty Bank weekly options expiry. On the Nifty, while we saw heavy writing at 10,700, 10,800 puts, indicating that the downside is protected, the Nifty Bank weekly options expiry yesterday, the Nifty Bank broke above that 26,300 mark, and we have a lot of puts just above that and just around that, which are fairly active. Yesterday, 26,200 call. That one saw a fair amount of short covering ahead of expiry today. So does that give a case for further short covering in the 26,300 and 26,400 calls is something we'll have to watch out for. As far as stock futures are concerned, there too we saw a positive cue coming in from the FIIs. They bought for the 4th day in a row, and yesterday was big, 1,875 crore worth purchase. And now we understand post the news that came post the markets that the kind of turnover that we saw in names like ICICI Bank, HDFC, that explains the kind of move that we saw on all those stocks.
Okay, Mangalam, thank you so much for that. As you mentioned, it is going to be all about the Bank Nifty today, so keep an eye out on that one. But with that, it's curtains down on Power Breakfast. From the team and myself, thank you so much for watching. Bazaar Morning Call comes up next.
See you, Doc.